Okay, family. How to pass the SIE exam on the first try, guaranteed. This is chapter 1. Equity securities. Equity on the test is also known or synonymous with ownership. When you own equity or stock, it represents a percentage of ownership. So if the question says equity, the answer is ownership. If the question says ownership, the answer is equity. With securities, a security in the financial world is a financial instrument that has value or it is worth some money. So in securities, has value. We got 4 types. 1 is stock. 2, bonds. 3 is currency. And 4 is derivatives. What we're studying right now is chapter 1, which is stock. And chapter 2, we are going to extensively as bonds. And now, let's say on chapter 1, which is stock, there are 2 types of stock. You got common and preferred. So let's say if we are a corporation, we're a company and we want to raise money or raise capital. The first letter in capital is C, and the first letter in corporation, the first letter in corporation is C. So when you get incorporated, and in the article, when you get incorporated, you are authorized to issue X number of shares. Now, once you are authorized to issue authorized shares, you're only going to issue a certain number. All the shares that actually get issued and are sold, those are considered outstanding. The shares that are issued and are sold are considered outstanding. Now, those shares, um, so you are a company and you want to raise money or raise capital. There's 2 ways you can do it. The first way you can do it is in debt financing, and that is when you issue bonds or you borrow money. We're going to talk about that extensively in chapter 2. The second way you raise money is through equity or selling a percentage of ownership in the company. Is 2 types of equity or shares you would sell. They are called common shares and preferred shares, or common stock and preferred stock. Let's say if you are issuing common stock, Four things you got to know about common stock on the test. One is the reason why you buy common stock is because you expect the shares to appreciate. So you expect the value of the shares to appreciate. That's why you buy it. Now, they may not appreciate, they might go down in value, but you want them to appreciate. So the value appreciates. Let me clean that up a little bit. When that value appreciates, we want it to appreciate, or we expect it to outperform inflation. So common stocks historically have outperformed inflation. That means it's also considered a hedge against inflation. It's also a way for you to protect your purchasing power. All that means the same thing. So don't get confused by that when you see it on the test. Now we want it, like I said, we want it to make money, but we want the value to appreciate, but it doesn't always appreciate. It could very well go down in value. If it goes down in value, company could go out of business. That's a whole nother thing we'll discuss in a minute. But this is why you buy it. The second thing, benefit of being a common shareholder or owning common stock is you get a chance to vote for the board of directors who oversees the company. Even if you don't attend the board meeting, you can vote, and when you're not there, by proxy. Also, common shareholders get paid dividends. Dividends get paid, common stockholders get paid dividends after preferred shareholders get dividends, or after preferred. That's why preferred stock is called preferred, because they get paid before common. And also, common stock is transferable, meaning it can be given away or you can sell it. That is everything you need to know on the test about common stock. Now, let's talk about preferred stock. Now, preferred stock has a few more moving parts. So let's say with preferred stock, two things. One, preferred stock does not appreciate. It has a fixed price based upon the par that's set. Don't get all discombobulated about par, but that's just a number that the company sets that sets the minimum legal equity. Meaning that's how much money they have to have on reserve. Next is the main benefit of preferred stock. It pays a dividend, also considered income. So now with preferred stock, there is one, two, three, four, five, six different types of preferred stock. So I got an acronym for you called parking. When you have preferred stock, that's when you parking. Preferred stock is parking. These are all the six different types. The first type of preferred stock is called participating. So it's already paying a fixed dividend, but if the company does well, they will pay you more so you can participate in the company's success. They'll pay you in success by paying you a higher dividend. or a dividend over and above the one that was fixed. The next is, and so that's easy. If you know the root word of participating is to participate, you participate in the company's success, they pay you a higher dividend. It's easily, you can, pick that out on the test. And next is adjustable preferred stock. Adjustable preferred stock is the dividend is based upon or could fluctuate based upon the interest rate. So if the interest rates go up, then your dividend could go up. The next is redeemable. Redeemable is also known as callable. Redeemable means the issuer or the company that issued the stock can call it back or buy the shares back so they can reissue them and pay a lower interest rate. So they can be called back. Let me buy those back and then I'm going to reissue them and pay less money. The next is convertible. Convertible shares can be converted to common stock. And what's the number one advantage or buying or feature of the common stock? It appreciates, or we expect it to appreciate or grow in value. So if the question on the test says what type of preferred stock is a hedge against inflation, it's convertible stock, because we learned earlier that common stock gives us a hedge against inflation. So if I can convert my preferred stock to common, then this preferred has that same advantage. The next C, now this is all over the test, is cumulative preferred stock. Cumulative preferred stock means that the company has to pay dividends on all the years they missed, if they missed any. So with a cumulative share, the company's got to catch up all the years they missed. Easy. So cumulative dividends got to catch up on the years they missed when they pay their dividends. And non-cumulative shares do not have to catch up. It's real simple. So if the board of directors decides to pay a dividend, they don't have to catch up the years they missed. They can just start fresh. Also on the test, let's say when a company, these are 4 dates you got to remember. Let's say if the company decides to pay a dividend, 4 dates that are important. The first one is the declaration date. The declaration date is a date that the company says that they were going to pay it. So they're going to say, all right, we are going to declare a dividend. So this day in the future, we are going to, declaration date. This date in the future, we're going to pay X number, we're going to pay this much on the dividends. We're going to pay this much in dividends based upon the shares outstanding. Now, this next date is really important. It's called the ex-dividend date. You have to own the shares of stock the day before the ex-dividend date in order to get paid. So it's really simple. So after the ex-dividend date, you will be excluded. Excluded. After the ex-dividend date, you will be excluded from getting paid. Then next is the record date. The record date is when they go through the list of all other shareholders and to decide to make sure who's getting paid. On the test, in chapter 1, the ex-dividend date and the record date is the same. And that's a business day too. And the last date is the pay date. That's the date that all shareholders get paid. Now, also on chapter 1, they're going to ask you a few questions about penny stocks. There's three things you got to know about penny stocks. Number one is they are valued is less than $5. They are not listed on an exchange. And they are only sold if they are unsolicited. Meaning, I'm the broker dealer, I'm the agent. I can't call you up and offer to sell you a penny stock. You can call me and ask for it. It would be considered unsolicited because you asked for it. That's what unsolicited means. Now, lastly, on the test, when it up here, when this company right here decides to issue, decides to raise money by either using debt financing or equity financing. Let's say if the company ever dissolves or goes out of business, when they sell off all of their assets and they liquidate, it's called dissolution. I mean going out of business and they liquidate all their assets. This is the order they have to pay their shareholders. So if the company goes out of business and they liquidate, when they have to pay the debt or bonds first, they have to pay preferred shareholders second, and they pay common stockholders third. That's another reason why preferred stockholders are called preferred, because they get paid before common stock if the company dissolves. Family, we are going to pass this test on the first try, absolutely positively. Write these notes over and over and over. Take the end of chapter quiz for chapter 1, and I'm pretty confident just using these notes alone that you should pass 80 or 90%. All right, hope that helps. Stay tuned for chapter 2.